when you change the investors, of course, you still have your existing ones, but there are also new ones coming aboard. How do you approach them? What is sort of a good way to approach investors for Series A or Series B rounds? Because they are usually, at least from my perspective, more professional. They're bigger firms than what you did in the past. So they probably also need a different approach than the investors you worked with before.
Yeah, I mean, but I think that naturally evolves as well. So through the series, if you gain professional investors already in the Series A, they'll introduce you to the B, and as you go through those stages as well, there's just less and less companies that are still in that space, and less, companies that also those firms that you mentioned will be looking at. So as you progress, it's much less easy, less hard to get the first meeting. I would put ever less emphasis on that. You got a meeting as you progress through those letters, and it's ever more about, did you have, a really good conversation? Did you really connect well with them? Did they pass you on to the really decision makers in the fund quickly? And did they react fast to it? Are they excited about the deal? All those points become more and more important. Further down those metrics, you look at more further down the funnel, if you wish, the fundraising funnel, and ever less about the introduction. So it's relatively simple to talk with all the funds after at least.
If I understand you correctly, it's not so much about just doing a cold email or a cold outreach. It's really your existing investors that give you the introduction, and then you take it from there. So it's sort of also really important which investors you have on board who can make and facilitate these introductions.
So yes, your existing investors can be a very key source, but I mean, warm introductions generally is how the market works still. But you can get those from other founders. You can get them from funds who actually didn't invest in you but still kind of liked you. So there's many sources beyond that if you don't feel, or your personal investors at that moment don't have the reach to reach everyone you want to. So there is still kind of that element of hustling, but I guess it becomes less and less because you're more and more interesting as well. You've already reached a certain stage. They're more interested in talking to you as well because they'll be able to learn from you. So there's much more in it from them in that conversation, versus if you're just like somebody with a dream and no proof points, and a 1 in 100 chance of making it in the earlier seed stages, right? So
I love that. Frederick, we mentioned the 20% roughly that you give away as equity per round. Kai mentioned that, but still the valuation is an important point of every funding round that you do. So is it just whatever money you want to raise multiplied by 5 as a rough valuation calculation, or how do you do it from a CFO perspective? Because you probably also want to go higher than that if possible, I imagine.
Well, so in general, yes, coming from a dilution perspective is for sure not wrong. In the early stages, especially, it's not really going to be multiple or discounted cash flow or whatnot. It's very kind of financial model driven. So the dilution perspective, I think, is a reasonable one to get you in the ballpark. And as Kai also completely rightfully said, your target ticket size that you want to raise is for sure. That's also a pointer in how the valuation will be set. I would say 20% is pretty good. I would say somewhere between 20% and 33%. Dilution, but really then ultimately depends on the dynamic of the round. So, at the end of the day, it's the market that gives you a valuation. You can have a really sophisticated discounted cash flow model. No one really cares. Ultimately, you have your first term sheet, and if you only have one, then your leeway will be limited. If you have multiple term sheets, that's when kind of deal making starts, and also optimizing on valuation, but also other key terms, which in my opinion are often overlooked. So look, if you have a super high valuation, but you have a 2x or 3x liquidation preference, so basically implying that investors first get 2x or 3x their money back before common shareholders get that, then you're piling up, a very high commitment from your exit valuation towards new investors, and that renders the valuation much less attractive, right? So I would, in tendency, really look at the whole, let's say, the plethora of terms, valuation being one of them, to assess, which investors offer the most attractive deal, and then ultimately it's also not always just valuation driven. there are cases where you might say no to a bit of a higher valuation because you truly believe that a certain investor can add much more value, even at a bit of a lower valuation or other more attractive terms, etc. So indeed, valuation is an art, and it has then to do with the momentum that you can create in the market.